I came from another industry to the investment field. In other words, I started as an outsider, and that is still true today. It began like this. I had sold my company and had money to invest. Perhaps I knew about as much about investing as the average person. I went to 4 different financial advisors and asked for a proposal. These were, I thought, pretty big name banks, brokerage companies, household name recognition. If anybody knew what to do, these probably did. After considering all 4, I decided to leave my money in the bank and do nothing. Somehow, it just looked too risky. They didn't think so and were not complimentary of my decision. For me, it was just a gut feel. That's all it was. Not based on anything else, but a gut feel. That was October 2007. For the next 17 months, I watched their recommendations collapse. I realized that they were smart people with good intentions, but also realized that they were part of an industry that just teaches people to put their money at risk in all investing climates. At this point in my life, this was not for me. I wanted to grow my money enough to outpace the rate of inflation, but I did not want to take the ride down the very steep elevator that I just witnessed. In 2009, this sent me on a personal journey of trying to discover a way to invest where I could largely avoid the downside of the market like I had just witnessed, but participate in the upside when market conditions were more favorable. That seems like a reasonable objective, but it is very hard to accomplish. Over that time, I developed strategies that accomplished my objectives. I made a few adaptations along the way, but today I believe we are being tested to see how this holds up. So far, so good. I will cover that later. My name is Ben Reppond. Today is June 21st, 2022. Welcome to my YouTube broadcast. And by the way, I'm not feeling 100% right now. I have a sore throat, getting over a cold, so I apologize for being a little scratchy in my presentation. So stay with me, please. Here are some subjects that I will cover in this broadcast. Why is the financial industry, the financial advising industry, so broken? A profile of some of the best money managers in America and probably in the world. And where are we right now in the next long-term economic cycle? Next, the value of currencies, the dollar and other currencies, in an unstable world economy. That will be covered by Ray Dalio. And then a clip by Russell Napier, the financial historian from Scotland, why he believes that we are in for high inflation for the next 15 years, based on historical data. And Frank Luntz, the pollster, will explain why 2 weeks from now we are in for a wake-up call. America is going to be in for a wake-up call for the real rate of inflation and the impact it is going to be having on America at that time, 2 weeks away. How far the economy has really fallen, a clip by Professor Jeremy Siegel from the Wharton School. And finally, market indicators in the U.S. and around the world from different perspectives. If you have ever worked with a more traditional financial advisor or financial planner, you may resonate with my story. And I'm not putting all financial advisors in the same category without knowing each of them. However, based on clients who have come to us, we get to hear this all the time. We share a common story. Traditional advisors, financial advisors, are often very nice people with very good intentions. I know there are a few who do not fit the description I'm about to give you. If so, I will exclude those people from my comments. I have these conversations every day. People are angry and they're starting to feel desperate. Let's get behind this issue of traditional financial advisors a bit and look at the things that I am being told. These also tie into the article in U.S. News that I read, and it caught my eye. It said, 7 signs your financial advisor is terrible. Well, I'm a financial advisor. I know I'm outside the norm. I'm, an alternative voice, but it still caught my eye. So I had to read the article. So I took the items that were listed in the U.S. News article and adapted them, used some of them and adapted them to 7 signs that I hear, the most frequent signs that I hear from people, but it's similar to the tone of the article. They are as follows. They, financial advisors, this would be a sign. They are not a fiduciary. What is a fiduciary? I thought all financial advisors were fiduciaries. Well, not really. According to the data that I've read, 88% of the industry, a financial advising industry, this would include stockbrokers, financial planners, financial advisors, investment advisors, whatever title they want to use, 88% are not fiduciaries. What is a fiduciary? That is a person who is in a position of responsibility and they put your interest ahead of their own interest. You may think that the person you deal with or the people in this industry are like that. That is not the case. Licensing can either allow or require that people put your interest first ahead of their own, and certainly not put their interest ahead of yours. That's 12% of the industry. The other 88% are licensed in a way that they can take care of themselves first, pay themselves first, and look after you second. Now, they don't package it that way. They don't tell you that, but that's what happens behind the scenes. When you peel back, where does the money go? That's the way it works, oftentimes. Number 2, they sell other commission-based products. So you may come to them with your money. You say, okay, I've got X amount of money, retirement account, IRA, rollover IRA, etc. I've got these accounts, and you think they're going to invest that money wisely for you. And then once they inspire your confidence enough that you let down your guard, they start selling you other products. Could be life insurance, annuities, mutual funds with loads on them where they get paid up front, all of which you pay for, by the way. And there's nothing wrong with commissions in a commission environment, but when you're in the financial advising industry, you don't want a big chunk of money taken off the top before you get to make any money. And that 88% of the population is licensed to and allowed to sell you products without disclosing this detail. Or if they do disclose it, it's so far buried in the fine print, good luck finding it. So that's another sign. Next one, they do nothing for their fees. Well, I don't mean nothing, but almost nothing. They just put your money in certain mutual funds or ETFs, and it sits there. The market goes up and down, your account goes up and down, and they do nothing. And people are really frustrated with this, that you mean You're supposed to be a professional. You're supposed to protect my money. You told me you were going to protect my money, and you've done nothing. And the account is sinking and sinking, and you're doing nothing. And that's another sign. They don't really manage your money. That's sort of related to number 3, but there is no management that takes place. They are available for a phone call. They'll help you. But when you look at your account, don't count on them making moves or changes or, okay, we're now entering into a period of risk. We need to reallocate it this way, or this is now a better period for investing. Let's take advantage of that. They don't do that. It just sits there. Goes down and goes up. They do not communicate regularly with you. Most people want to be communicated with. Tell me what you're doing, why you're doing it, excuse me, what you're investing in, and just regular communication. And people oftentimes get very little of that. Easy to read monthly statements. Everyone has a custodian where your money is, and you get those statements. They're many, many, many pages long and confusing. And good luck reading them and understanding what they say. And there are ways to get that data into an easy to read format so you can know what is your rate of return, what are your balances, what was your balance 3 months ago, a year ago, whatever. What about all of your accounts? There's a way to do that in an easy to read format. Do they do that? Oftentimes I'm told people have no idea. They just hand me a statement and say, here's what I got. And I said, do you know what it says? They go, I have no idea what it says. And that's the industry. And finally, people report that they feel rushed in a conversation. When they talk to the financial advisor's busy, they've got other things going on, they've got people waiting for them, and they feel like they're saying, I need to go now. Did I answer your questions? If you have any more, feel free to give me a call, but I've got an appointment waiting for me, or a phone call, or I'll get back to you next week or something. And there's this feeling of, I've only got so much time, I've got to say what I want, and whatever sound bites they give me, that's kind of what I have to live with. Those are signs that a financial advisor is terrible. To take that a step further, when people complain, when I talk to them, they usually have already talked with their financial advisor and been very frustrated at the answers they've gotten. They're given what I call sound bites, and they're left like, this doesn't feel right to them. And I don't want to say this impolitely, but the best lie always has some truth in it. And there's some truth in all 5 of these things. But all 5 of them leave investors feeling empty. They say things like, we didn't see this coming. Oh, really? A lot of people did see it coming. You've got to invest for the long run. I can literally tell you that there are people I've talked to who are in their 70s who are being told you have to invest for the long run. I understand a person in their 20s or 30s, that's a fair statement, but not when you get older. It's a hackneyed phrase that it just falls kind of on deaf ears, really. You can't time the market. Whatever. You can't sell now. Well, probably true. But why am I in the position where I even have to talk about selling when I should have been selling a long time ago? And some people did. Why am I dealing with a financial advisor that lets me now get to a position where I'm told now I can't sell? And then it's going to come back. I talked to one person who said their advisor told them that it was literally, they felt that the market was going to recover its losses by the end of the year. Now that is a lie. That is ridiculous. It is not going to recover its losses by the end of the year. It's going to take some time. There's a lot of damage in the market. It could go lower. I personally think it will, but whether it does or not, you don't recover from those kind of losses that quickly. Not when it comes down that sharply, that far. It takes a while to work itself back up. On this slide are 7 men. They have several things in common. I'm going to talk about a few of those things. At the top, you see Warren Buffett, Seth Klarman, Jim Rogers, Ray Dalio, Jeremy Grantham, Mark Cuban, and Michael Burry. What are the things they have in common? First of all, they are successful money managers, and they manage money entirely differently from each other. Not the same way, but in their own way, they're all successful. They do not follow the crowd. Whatever the traditional approach is for investing, let's say your financial advisor uses a traditional approach, a buy and hold 60-40 portfolio, 65-35, whatever it is, that's kind of the traditional norm. They don't do anything like that. Not close. I'm not able to see the portfolios of each of these because mostly what they do is private. Warren Buffett is public, so you can look at his more clearly. And Warren Buffett's style, his methodology, everything about it is not even close to the financial advising industry. And thirdly, they do not own bonds. When I say they don't own bonds, I mean they don't own much bonds. I have not been able to find where any of them own bonds, but if they do, it seems like it is very, very small. And they do not do it the way the traditional financial advising industry does it. That's interesting. So here they are, these most successful, or 7 of the most successful money managers in America, and what they're doing is different than what you're told to do. That's odd to me. Why aren't you being told to do things like this? It's curious. I have my theory, but it's just a theory. Every investor wants the same thing. They want an attractive rate of return with as little downside risk as possible. And by the way, these men want the same thing. They want as little downside risk as possible with the most optimal return. So I don't know why they completely reject the traditional investing methodology, but they do. Warren Buffett is, I know, probably the most outspoken about bonds or bond funds, as he says, I'll paraphrase, I would not own a 2-day bond even if one existed. So in other words, a 2-day bond, if one existed, that would be like a savings account. He goes, I have no interest in bonds. And his statement is similar to the comments that I've seen from the others, and they just don't see it as a way to invest successfully. This is an interesting chart. When you look at it, it looks like a lot of squiggles going in a lot of different directions. And what are you trying to say here, Ben? So I want to show you this. Look at the dark blue line, a lot of squiggles. The dark blue line at the top goes up, comes down, and goes up again. That's the price of bonds. He didn't say which bond. I'm assuming it's the 10-year Treasury, but I don't know that. The overlay, the light blue line, is the yield on bonds, the coupon that they pay, the interest rate, you may think. Down, up, down, opposite directions in a macro way, not precise, but in a macro way, generally moving in an opposite direction from the price of bonds. So when you look at the last 40 years, you see the black arrow on the right tracking the bond yield going down. The bond yield went from like 15% down to about 2%. Interest rates went from 17 to 18% down to 0. So, but they've tracked very similar. So it went down. So where do interest rates and bond yields have to go now? They have to go up. Well, what are we witnessing? They're going up. Of course they're going to go up because they hit a bottom. The financial industry, the financial advising industry, has not looked at that chart. And they have not connected the dots that means the 40% factor of your 60-40 portfolio, it's basically going to be toast. Because this means that as those go up, bond prices are coming down. That means the bond portion of your portfolio is pretty much designed to collapse. And I'll show you what's already gone on with bonds. So when financial advisors have access to the same information that I do, why do Warren Buffett and that group of managers, why do they reject bonds? I can see why they would reject them. It's a no-win situation. There's a lot of risk, there's not much reward. This is a chart, another macro chart, goes back to 1950. So 1950 to present, that's about 70 years. So when you look, actually it's 72, I guess. So when you look at that, you can see that the chart goes up and down, up and down. So, and then I do a regression line right through the middle of the data. This is a ratio chart. The numerator is corporate equities. We could call that the stock market. And the denominator is GDP. We could call that the economy. So we could say, roughly speaking, the stock market divided by the economy. Why is that relevant? Because the economy drives the stock market. So in other words, if the stock market gets ahead of, becomes more expensive than the economy that supports it, those prices are going to go up. On the other hand, if the prices are below what the economy supports, in other words, the economy drives the price of the stocks, and if the stocks are selling at a discount, they're below the regression line, that's a bargain. That's a time to buy stocks. But look where we are today. The far right of the chart, that's where we are today. It goes up and then it comes down just a little bit. Do you see that? Comes down just a little. Do you know what that tick down is? That's the first 6 months. Excuse me, it's the first 5 months. This is through May. The first 5 months of 2022 is that little tick down. And you may think we have come way down. Portfolios are down, bond prices are down, stock prices are down 20 to 30% or whatever. That's represented by that little tick down. Do you see how much further that has to go to really even get back to the regression line? We are still overbought in equities. Prices are still elevated. Yeah, they've come down. Relative to the economy, not much. Now that former chart was an exponential chart, is a logarithmic chart. This chart is not logarithmic, but it is inflation adjusted. And it's not logarithmic because when you see that kind of data, it doesn't have to be logarithmic. It's, just inflation adjusted makes the point. This goes back to 1870. So this gets us about 150 years of data. You can see, this is a very macro chart, you can see represented by the blue part of the line, those are what are considered bull markets. The red lines, red portions of the line, are bear markets, when the market is collapsing. In the last 150 years, there have been 4 bear markets. There have been 5 bull markets. Okay? They all look different. I mean, they're kind of all over the place. They never repeat the same pattern, but they all go up or they all go down, you know. So there have been 4 bear markets. Where do the bear markets start? They start at a top, and then they come down. And usually you can see these go from, I think the shortest one is about 10 years, the longest one is about 20 years, and the other 2 are somewhere between 10 and 20 years. These are long cycles where the market works its way down, it goes up some, but generally the general direction is down. And here we are today. I put an arrow at the very end of it, and you can see again, here we are today. That little tick mark down shows you how far down we have come. And I look at it and say, how far down we have to go. At some point, that's got to happen. If you believe in cycles, that has to happen. They go up and they come down. They go up and they come down. And to just take the traditional financial advisor to say, we're going to be okay, stay in your seat, it'll be up at the end of the year. Good luck. I don't believe that. I'm going to jump over to Bitcoin now. I do know that from the YouTube videos, I do have some critics, and they don't like me criticizing Bitcoin. So I'm not trying to attack that per se. I don't have a vendetta against Bitcoin. And I know the people who believe in it are very evangelistic about it. But I don't hear much of a cry for buying Bitcoin now. But boy, when it was high, when it was up around 60,000, 65,000, people were saying, this is going to the moon. No, they didn't say that. They said it's going to 100,000. It's going to 250,000. Well, now it's down around 21,000 and falling pretty fast. It has dropped along with the market quite a bit. And it is not attractive to me. Will it become a means of currency? It could be in the future. I won't say it wouldn't be. I don't believe it'll be the currency, but I think it could be a form of currency. But for me as an investment, it doesn't meet the criteria I'm looking for. Number one, it's way too volatile. I want things that are not volatile, not going towards something like this. Number two, it's correlated with stocks. So when stocks go down, it goes down. It's not a store of value. So when stocks go down, it doesn't hold up, unlike, say, gold does. So one of the very successful money managers in America is Scott Minerd. He's the global chief investment officer of Guggenheim Funds, well respected in the industry, and is the top mutual fund manager in his fund category in America, consistently outperforming all of his peers. He said this. This is interesting. Think about this. I want to comment on it. He said, the collapse of crypto is the canary in the coal mine. Crypto told us ahead of time that stocks were going to be in trouble. And until we find a bottom here in crypto, we're not going to get a bottom in anything else. Very instructive, very interesting. The canary in the coal mine, a leading indicator. Who ever thought of that? I'm not even sure we were thinking at one point that it was correlated with equities. And now, yes, it is correlated with equities and is perhaps, according to Minerd, a leading indicator. Interesting. From some previous videos, I got a lot of questions on this, so I thought I would cover it. I've mentioned buying silver, that I buy silver, and people, you can do what you want to do. It's up to you, but I just mention it because it's what I do. I use silver as a store of value and as a insurance policy against the devaluation of the currency or the eventual collapse of the currency. And so people ask me the question, should they buy physical silver or gold? Gold is the same category. Paper or physical? I only buy physical. I buy silver bullion rounds, 1 ounce rounds, and pretty simple. And you could buy silver eagles, you could buy bars, 5 ounce, 10 ounce, 1 ounce, whatever you want. They're all a store of value. I just do the 1 ounce bullion rounds, but not paper, SLV, paper derivatives. Why? The number one reason is I want something I can barter with if I needed to. And number two, the derivative is denominated in dollars, and I'm trying to get something to insure against the risk of the dollar. That doesn't make sense to me that I would buy paper. Next question I get is physical versus digital cash. They don't usually say digital cash. They're trying to figure out, how do I go from my money in the bank to cash? What are you saying? So what I refer to is, in the physical cash, I mean $20 bills. So I mean truly physical cash. So if you want to insure yourself against not being able to get your money out of the bank or the collapse of the banks or whatever, again, I'm thinking of worst case scenario, so I'm not a doomsday person. I'm just saying I want to hedge my bet. So if that becomes an eventuality, it has before, that's how I want to protect against it. And then you could take a brokerage account. I use TD Ameritrade, but you could use a brokerage account and put money in there, and that diversifies it out of the bank, and that money's insured. So it's still digital, but it's technically further outside the banking system than literally sitting in your bank. And you may say, well, my bank deposits are insured. Do you believe everything the government tells you? It's a serious question. Do you really think, our country is broke. We're 30 trillion in debt. And we're getting to the point where I don't think we're going to find people who will buy our debt. Do you really think if there's a run on the banks that they're really going to stand for bailing everybody out at $250,000 per account? Sorry, I'm a little skeptical on that. And where you choose to hold it, that's up to you. It's a safe place. Okay, I want to play for you a clip from Ray Dalio, and he talks about world currencies, his view of world currencies, and how not just the dollar, but how the store of value issue comes into play. It's just a perspective. I'm not saying that this is absolute truth. It's good to get Dalio's perspective, and I'll play it for you.
There are two purposes of a currency, which is a medium of exchange and a storehold of wealth. And we're living in a world where we have three major currencies are fiat currencies with the same kind of problems. So you can't look at one currency in relationship to another. I think people make a lot of mistakes of thinking, it's an ugly contest. The questions that we're going to be in is storehold of wealth. Okay, what is your storehold of wealth? And a money is a storehold of wealth that also is widely accepted in other countries so that you can move it around. It's not just limited to currencies. Don't think that medium of exchange is the only important thing. So think about the store of the wealth. That's when we deal with the quadrant of the four pieces to try to find a balanced storehold of wealth. And then you have to think, can I move that and sell that anywhere? Am I going to have the free capital markets to do that, or are they going to be a problem? So the diversification of that, and I think we are entering a period where all currencies, the traditional medium of exchange type of currencies, are a lot of currencies will compete. What will be the medium in which I could take something and go someplace else and cost effectively convert that into buying. Okay, the medium of exchange. So I think we're in a storehold of wealth issue. In other words, focus in on that. And then, okay, your transaction cost of converting that storehold of wealth, a balanced portfolio, into buying power. And then you transact, because even in the worst inflations, the worst environments, the currencies, most of the time, still could be mediums of exchange, even though they're devalued. So I encourage people to think about bad fiat currencies generally, and think about storeholds of wealth and what the liquidity is, and think about even what capital wars look like.
Okay, now I want to just run through a few economic indicators because I think this is helpful. This is the Philadelphia new orders. Now, each of the Fed offices track certain elements of our currency and our economy. This is from the Philadelphia office, and they're tracking the new orders. These relate to manufacturing. So when you can see where it is today, and I put a blue arrow on the right side. So the new orders have dropped off significantly and seem to be on their way down. And you can see I put the red arrow 2008, 2009, and then I put the pandemic 2020 of where that happened. Just in one quarter, went down very quickly. Now, the survey is asked of these manufacturing companies, what are your expectations of new orders based on what they're hearing from customers? Look at where the expectations are today. And they're saying, this is what I expect for the future, but the survey is today. It is at the level approximately of 2008, and it has dropped rapidly. It has dropped faster than 2008 dropped. As you look out, and as these manufacturing companies look out on their expectation of orders, as far as the eye can see, it looks dim. So I want us to return to a growth economy where we can invest in the stock market and get good returns. That day is not today. So I don't know when we're going to return to that. It seems based on history at some point we will. That's the hope that I have. But for now, I don't want to just put my money in a buy and hold portfolio and just ride it all the way out when this is what the future looks like according to the manufacturing segment from the Philadelphia Fed. This came from the U.S. Department of Labor and Wells Fargo Economics. The red portion at the end is the forecast. So they're saying we're going from an unemployment rate, which is very low, of 3.8%, and eventually get back up into that 4.5% range, that there will be more people becoming unemployed. It's a very tight labor market, obviously, right now, but they're saying this is probably headed on its way back up. I want to play 2 minutes of a clip from McAlvany Weekly Commentary, the podcast by David McAlvany. He played this on May 4th, 2021, so a little over a year ago. And it was an interview that he did with the financial historian Russell Napier in Scotland. And Napier is regarded as probably the foremost financial historian in the world, and is able to, with his knowledge of financial history, a lot of times able to help connect the dots between what has happened in history and what's happening today, or more importantly, what will likely happen in the future. So McAlvany presses him on the question of inflation, about what is his view of the duration of high inflation. And here is that clip showing McAlvany's question and Napier's answer.
So you're saying this is not a new business cycle, but rather the beginning of an age of inflation and repression. How long is the trend likely to be with us again?
Yeah, it's a great question. And of course, we've been here before, so that gives us some sort of guides to this. So let's pick the American number. And America benefits from having a very long-term data set. So I can tell you that leaving World War II, the total amount of debt in America, so that is the government plus the household sector plus the non-financial corporates, was probably about 140% of GDP. And it's now 290. Now, one of the problems is when people look at all this debt data, they tend to just focus on the government, but we need to focus on the whole system. Now, I would argue very strongly that a reasonable number to have is certainly below 200% of GDP. At above 200% of GDP, we have seen constantly in recession and falling cash flows, real problems with the private sector defaulting on their debt. So in answering your question, how long is this policy going to have to run? It's going to have to run long enough to bring America's total debt to GDP is going to have to come from 290% to closer to 200%. The advanced world average is 311%, slightly higher. France is 374%. Japan is 411%. So the magnitude is big. So therefore, you're talking about a decade to a decade and a half. And it will depend upon the gap between inflation and interest rates, between nominal GDP growth and the interest rate. But if that's kept at a level which is not dangerous, we might come back and discuss what dangerous means, but if it's be kept at a level that isn't dangerous, it's probably a 15-year new structural system put in place, and we end up with debt to GDP levels closer to 200% than 250%, and that's when we may be able to move on to more reasonable policies which aren't based fundamentally on a wealth transfer from savers to debtors, because that's what this is. It's to get money from the saver to the debtor to create a safer system with lower debt. So I'll go for 15 years as the best guess as to how long it will take.
Now I want to move to one more clip. This is from CNBC, and this is where Joe Kernan is interviewing Frank Luntz, who is the pollster, and asks him a really important question about what he sees on inflation. And Luntz answers this. This is just a small clip, but he answers this about what's coming 13 days from today. And he says it's going to be a shockwave, or words to that effect. And it's going to hit America hard. And it's an interesting perspective. We'll see if it plays out. But maybe this is based on what he says the polls are saying. Here's a comments from Frank Luntz.
Current polling shows 83% of Americans describe the current state of the economy as poor. This comes alongside President Biden's approval numbers continuing to drop, approaching the midterms in November. Joining us now is Frank Luntz, pollster and political analyst. And in your long career, Frank, we've seen some, I guess, other periods where inflation finally rears its ugly head, but it's been a long time, but few things really get the juices flowing like seeing a grocery bill or a gas bill and just going, whoa. I mean, that really is, it affects everyone and it's visceral, I think. Are you seeing that in polling?
Yes, we are. And the tragedy is that we've tried to explain this to the Biden administration because they're the ones that need to know, and they've refused the presentation. So on your show, I'm going to tell you what I would have told them if they had only listened. We are 13 days away from an absolute explosion on inflation. There are 3 holidays, there are 3 moments when Americans take to the roads and when Americans buy more food than at any other time of the year. Christmas, Thanksgiving, and the 4th of July weekend. And everyone's going to be filling up their car 13 days from now, and they can't put $40 or $50 in their tank. They actually have to fill it up, and that's when the explosion hits. They can't just buy 80% of what they want. They have to fill their shopping carts for the barbecues and the cookouts. And 13 days from now, the American people are going to come face to face with these higher prices and face to face with the fact that they can't afford it. You have to go back to 2009, 13 years ago, to find a time when these economic numbers are as bad as they are today. And the difference is that back then it affected roughly 60% of the population. Now, with inflation, no matter who you are, no matter where you live, no matter how much you make, you're impacted by it. And that impact will be felt shortly.
Now I want to move over to my dashboard and show you different indexes, U.S., abroad, sectors, etc. And I'll draw your attention to some points I want to make. This chart shows the various indexes, the Dow Jones Industrial Average, and I'll just I focus on the far right side, just year to date. So the Dow Jones Industrial Average down 18% year to date. The S&P 500 down about 23%. This is what's interesting. This is why I put it in yellow. The long-term government bond exchange traded fund, TLT, down 24%. Can you imagine that? Have you ever seen that? I've never seen it. What was supposed to be the insurance policy against equity risk has now turned against the investor, turned against the financial advisor who was using this or bond ETFs like this to protect against equity risk. Gone. It is down more than the S&P and the Dow. Wow. The insurance policy is gone. NASDAQ 100 down 31%. The tech component of the NASDAQ 100 down 36%. And I have to include the RK Innovation Fund down 59%. And of course, Netflix down 71%. This dashboard shows, the thing I want to mostly focus on is on the far right of the chart. There are 4 dots per line, and these represent the 20, 50, 100, and 200-day moving averages and where this asset is relative to their averages. And I was asked to put in gold and silver, GLD and SLV, just so we could see that relative to the others. And then I included Netflix, and of course I included Coinbase, just so we could see what's going on. Everything is down. Everything is down. We've got to have a green dot in here somewhere. No, they're all down. 20-day, 50-day, 100 and 200-day moving averages, all down. Gold, silver, Dow, emerging markets, developed markets, S&P 500, Russell 2000 small cap index, NASDAQ 100, Netflix, and Coinbase. Now those are all in the increasing amount of year-to-date performance. But no matter how good or how bad they did, they're all below all of their averages. And by the way, Coinbase is down almost 80%. Then I break this into sectors. There are 11 sectors in the S&P 500. Same thing, I'm looking for what is above its moving average from the sector standpoint and what is below that. Now, the only green dot we got out of this was energy. XLE is above its 200-day moving average, but everything else is below its 20, 50, 100, and 200-day moving averages. So yeah, energy, consumer staples, healthcare, basic materials, industrials, financials, real estate, etc., all in very negative territory. It is a very bearish sign right at this point. The Jeremy Siegel, Professor Jeremy Siegel, is the distinguished professor of finance at the Wharton School, Business School, and he gets an interview and with CNBC, and they with Scott Wapner from CNBC, and Scott asks him some questions, and he's really trying to get his take on the economy, but also the stock market. This is Professor Jeremy Siegel, very renowned professor who has studied this for decades, and this is an interview with him. I thought you'd find it helpful to get Dr. Siegel's perspective.
What is an investor to do? Let's ask famed Wharton School professor Jeremy Siegel. He joins us today from Philadelphia. Professor, it's good to see you. Welcome to Overtime.
Yeah, I agree with you, Scott. This week was brutal. Today was brutal. Let me tell you, we're in a recession. It's a mild recession. It's not an official recession by the NBER, certainly not yet. But this first half is negative GDP growth, and it's ending on a slide. And, just when the Fed is, the most aggressive because it waited far too long, it's interesting. I mean, the data that I found so interesting on Wednesday, more even than the 75 basis points FOMC was that retail sales data that we got in the morning. Wow, that was shockingly low and momentum downward. And every single indicator we've gotten since then has really surprised pretty dramatically on the downside. So we're cooling off the economy. Let's just hope it's not too fast.
You point to a significant issue that we need to discuss, and that is the idea of a Federal Reserve that waited too long and now is acting too much. And that seems to be where we are in this world, what has unsettled this market so dramatically, this very issue that because they waited so long, Professor, and they're doing what is deemed to be too much now, they're going to break something along the way.
Yeah, and remember I commented, 3 weeks ago that we already had stopped the growth of the money supply, which was the second largest monthly decline in 60 years. I was sort of startled. I said, something's going on here. We're going to get another money supply soon. It looks like they're stopping the economy right in the tracks. We don't want to go through the windshield here, slamming on the brakes. They had to do it what they had to do. We might be surprised instead of 50 to 75 basis points in July. It might be 25 if this slowdown really continues. Now, we saw oil up a bit today, but we know so many of the other commodities have rolled over. And the economic momentum is really sharply turned negative. And I think that's certainly something that the Fed has to be concerned about going forward.
You can't have it both ways, though. You wanted them to do 100 basis points.
I wanted them to. Yes, and it's to capture the negative that we're serious, and I think they did that. We've seen a rise. I look at the TIPS yield because I think that's the most relevant discount rate for the stock market, and I've never seen a rise like this. It was less than -1 at the beginning of the year. It almost earlier this week hit +1. Now that's a 2 percentage point increase in the discount rate. That is mammoth in a period of less than 6 months. So you wonder, why are stocks down 20%, 25%? Put that in a discount formula, and you will see why that is happening. And that is really all on anticipation that the Fed has to step on the brakes, slow that money supply. It is happening. Let's hope, they can't go overboard. They got to be looking at this data. Being too late sometimes means that you may react too much. Not yet, but we're in the problem. Now, Scott, let me say something on the good side. On the good side, despite the fact that the first half of this year, GDP is down, earnings are up 5% over the previous 6 months of last year. So even with a negative GDP growth, we actually managed positive earnings growth. So that's actually saying something. And also think about the fact that we're going to be in earnings week, and we're going to be at the end of the quarter in 2 weeks. Then 1 week after that is earnings season. I haven't heard a lot of warnings. I mean, we heard Target. Not yet. This is the time. Now, maybe the fall off, we're going to start getting them. But by and large, even with this slowdown, earnings are coming in fairly good. A definition of a recession technically is 2 consecutive quarters of GDP. Now, we're not going to get 2 consecutive. And by the way, the only reason we're having positive GDP, and I think we will get slightly positive in this quarter, is really what we saw in April and early May. End of May and June so far is a negative GDP by all indicators.
I'm going to jump into the charts that I do every week. These give you a view from different perspectives of the stock market. This is a 1-year chart. It's a weekly chart showing the 1 move equals 1 week, and both up and down. And you can see that for approximately the first 6 months of the last 12 months, generally speaking, the S&P 500 moved up. And then it got to late December 2022, and it began its trajectory down. And you can see just the S&P 500 relative to nothing else. You can see the direction that it has gone and how far below the 20-period moving average it is, which is right above it. Contrast that with how it was during the first 6 months of this year. When you take the S&P and you divide it into 2 categories, both the growth stocks and the value stocks, there are ETFs. One is SPYG for growth, SPYV for value, and they're comprised of the companies in the S&P 500 that are either growth or value. So you can see during the first part of the chart how growth outperformed value. And since about November to present, how value has outperformed. So if it goes down, that means value is in favor. If it goes up, that means growth is in favor. It's a relative value chart, and it's a ratio, the plotting of a ratio, if you will. And this is another ratio. This is a small cap index. The ETF is IWM, is the Russell 2000 small cap index. And it is plotted as a numerator, plotted against the S&P 500 SPY as the denominator, and this line represents that ratio. And the line above it is the 20-period moving average. Now get away from relative performance, relative strength, over to absolute, and I go from a 12-month to a 24-month. So the long-term government bond, TLT, on a 24-month basis, a weekly chart showing the showing the absolute performance of TLT for 24 months. There are 2 periods that marked by the red line down, and then the last period is the black line down, which is the current period going from December of 2021 to present. It's just been in a period of decline. And of course, you've seen, I've talked quite a bit about bonds being so beat up, and here we are. And whether it's the intermediate term, long term, or short term bonds, or corporate bonds, high yield bonds, they're all down. This chart is similar. They're just down different percentage amounts, but they're down radically. And then this pattern began in about over a year ago. You can see from the red line. And gold, GLD, I just use this as a point of reference just to show what the price of gold is doing. And you can see that mostly it's just up and down. It's not really going anywhere. It maybe has a little bit of a slight upward trajectory. I put the black line in there, but you could also say it's probably just a lot of up and down. And then on silver, it probably has a little more of a negative trajectory. It's going down a little bit more, and but again, still a lot of up and down. When I plot the two on a relative basis, using SLV as the numerator, GLD as the denominator, and plot that ratio, this is what that looks like. And you can see that for the first, looks like about 8 months, silver outperformed gold. And since that time, for, 14 months, it looks like gold has outperformed silver, which means it is declining. The volatility index is a measure of the volatility of the market and the S&P 500. If it is rising, that means there's increased volatility in the market. Doesn't mean the market's going up, it means it's probably going down. And the red line is the benchmark at around 24, where we look to say, is it above that or below that? Well, it's above that and rising. So that, again, is a negative indicator for the market. I want to cover some metrics from Asbury. Their Asbury 6 model shows that all 6 of their measurement tools are negative through last Thursday. So the second chart from Asbury is a cross-asset relative performance set of metrics comparing performance of this asset versus that asset and comparing them for the last week, the last month, the last quarter. So it's a good view of kind of what's in favor and so forth. So they use the ETF, the benchmark for bonds, as AGG. That's commonly used as a benchmark. It's not down as much as, for example, government bonds are. But anyway, AGG bonds are doing better than stocks. High volatility, high beta versus low volatility is better in a down market. In an up market, it would be the inverse of that. The Dow versus the S&P, the Dow is doing better because it contains more value-oriented stocks, and value is in favor over growth. Developed markets versus the U.S., developed markets are definitely doing better, and emerging markets are definitely doing better than the U.S. for the last week, the last month, the last quarter. That has been true for a while. And then in fixed income, in the bond area, corporate is doing better than high yield. This is the chart showing the performance of the U.S. versus other countries. The U.S. measured by SPY. The U.S. SPY is compared against these 21 plus some regions of the world. In no case is the U.S. market or SPY doing better than any of these 21 countries or regions in the world. Isn't that interesting? We are doing worse than all of these from a performance standpoint in the stock market. Those doing quite well against the U.S. are Hong Kong, Japan, Malaysia, Spain, Singapore, Taiwan, India, China, Russia, Thailand, and the regions of Pacific and the emerging market sector. All doing better than the U.S. Gold and silver, as of Friday, the gold was 1841, down 1.8%. Silver 2169, down 1.1%. Demand is sky high. You could not tell it by, this is what's called spot price. This is just the agreed upon price or the manipulated price, whatever you want to call it. It's the baseline price, not the price you'll pay for it, but the price that from which discounts occur or premiums get added. On the retail side, you pay a commission or premium on top of that, and so forth. saw this cartoon. I thought it was interesting. Thinking of crypto, no regrets. I love crypto. The crypto crowd is very, I said evangelistic. They very much believe in crypto. It went from 68,000 to 21,000. That's okay. We still believe in crypto. Yeah, why don't you tattoo that on my arm? I wanted to close with this. I wanted to say thank you to everyone that watches. 3 weeks ago, I had a video that just did amazingly well, thanks to YouTube and to those of you who watched it. It is now over 300,000 views, and that blows me away. And we've picked up about 8,000 subscribers. I can't even comprehend that. So very, very appreciated. So thank you for watching, and thank you for liking and subscribing. If you have questions or comments, feel free to leave them in the comment section below. I'll do my best to answer them, particularly if you ask for a response. Thank you again for watching.